Welcome to Subramani. Please hit the bell icon. This is going to be quite a complicated video, so please you may want to hear it more carefully than you would, or perhaps even make notes. Once you understand, please make sure you pass it on to more people. See, the more the number of people who like the video and who share it, it means the algorithm allows this to spread far wider. To me, it doesn't really matter. This is not a sponsored video. No, I don't have a target that it has to reach 100,000 people or something like that. But some of these concepts are really very important, and I don't know too many Indian YouTubers who make videos on concepts like this. So one question somebody asked me is, you're saying no asset is safe, all assets are fully priced. Debt is fully priced, perhaps equity is fully priced, perhaps gold is fully priced, silver is fully priced. So if everything is fully priced, where should I put my money, right? So let me put it this way. No asset is safe. Every asset which goes up will come down, whether it is real estate, gold, silver, equity, debt, doesn't matter, right? If it is appreciated 50% last 1 year, there's a good chance that it will fall somewhat. May not fall 50%, may fall 10%, whatever, but good chance that it will fall rather than it will go up, right? What I'm trying to say is some assets will fall less and some are negatively correlated. Negatively correlated means, typical example is when you invest in a company making ice cream, you also invest in a company making umbrella, because in case if there is more rain, you will need the umbrella, and if there is more sun, the ice cream will sell well. So negative correlation. This is how can this be handled? This can be handled with portfolio diversification and portfolio sizing. How much of weightage will you give? Just because gold is going to do well or has done well in the past 1 year, will gold be 50% of your portfolio, right? That is portfolio sizing. So this is a very basic principle of investing. Every asset carries inherent risk. Make no mistake. Public provident fund carries the risk that inflation will just demolish all your returns, right? So if inflation in India is 8%, then your 7% return in PPF is absolutely useless. Government could lock it in for a much longer period and say, no, you cannot withdraw it in 15 years, you can withdraw it only in 25 years. All these are the risks in PPF. So there is nothing called a risk-free asset, and every asset which goes up will also likely come down. But risk can be mitigated because assets behave differently. Some decline less during downturns, some decline less during when the market is booming. So some may move in the opposite direction. I mean, sometimes gold and equity move in opposite direction. There could be a negative correlation, but that could be for a small part, and for a longer part they could move together based on interest rates, right? This is managed through diversification, which means spreading your investments across uncorrelated or negatively correlated assets. Maybe you put some money in China, some money in Taiwan, some money in Japan, and saying, okay, if the Indian market does badly, I'm making money there, right? So that is also a method of diversification. Or negatively correlated. Sometimes it can be negative correlation also. And portfolio sizing. What else can you do? I mean, you have to worry about global events, you have to think about everything, but then you can't say, oh, if the world is going to come to an end, so I will not invest. Then the risk of not investing is inflation will erode your assets. So let us accept that whether it is in India or in the world, no asset is truly safe. Anybody who thinks any money is safe, they are completely wrong. Your money is completely safe in savings bank account in the short term. But over 30-year period, inflation will make sure that it is not worth the money that you put in, because inflation would have eroded its value. So all investments face risks such as market volatility, inflation, erosion by inflation, taxation. For example, savings bank account, whatever money you earn, you will pay tax at the maximum marginal rate, right? So in equities, what is the risk? Well, stocks in the Nifty 50 can also plummet during recession, right? There's nothing to say that good companies won't fall. I think over the last 15-year period, Colgate has underperformed the index, right? So you don't think like that, right? How can Colgate underperform the Sensex? Possible. Asian Paints may have done badly for 3 quarters, 4 quarters. So this kind of volatility risk is there in equity. In debt instruments, you have your G-Secs. Again, interest rate risk is there, because when you invest when the interest rates are low and the interest rates go up, you will see erosion in value. Right now, interest rates are pretty high. I'm not even saying it can't go higher, but when it comes down, let's say suppose now it is 7% and the interest rates come down to 4%, then obviously you're going to get a lot of capital appreciation. But imagine the reverse. If interest rates were 2.5%, 3% now and it went up to 7%, you will see erosion in value. Gold, sometimes seen as a hedge, has done extremely well over the immediate short term, but over a 20-30 year period, it has definitely underperformed equities in most parts of the world. When you're looking at gold prices in India, you have to also remember it is performing well vis-a-vis the dollar. That is more important, because if the rupee becomes a free currency, gold prices could come down. So real estate, we have all seen real estate. People claim that it appreciates, but rent does not go up. If rent is not going up, it means the real estate base price is not going up at all. And if the brokers are telling you, they're telling you a lie. So again, like I said, all assets don't move in lockstep, right? They don't. Equity goes up by 5% doesn't mean debt will also go up by 5%. Debt may go up by 1%. When equity falls by 5%, debt may not go down at all. So in what we are trying to do is find the correlation, which is measured from negative inverse to identical movement, determine how they interact, low or negative correlation. Then when one asset class falls, the other one rises. That's great. So Indian equities often show low to moderate negative correlation with Indian debt, which is easy to understand. If I have invested in, say, Tata Steel equity and it is doing very well, the chances are the debt will also do well. And when the equity is doing badly, chances are debt will also do badly. So investors tend to flock to bonds and during stock market turmoil. So during stock market turmoil, bonds might actually go up. So that is one thing which can happen. Equities and gold have very little correlation, maybe a little bit of negative correlation at some stages, but there is nothing. It's not very easy to build that and build it into your portfolio. Equity and real estate show low to moderate correlation. In fact, I think when equity market booms, people take some money out of equity and buy real estate. So that could also happen. When equity market is ending or is at its crescendo, that's a time when some people sell, many people don't, and they buy real estate. So if that is a time when real estate is low, it's a fantastic deal that you have done. So typically in the Indian situation during COVID-19 market crash in 2020, the Nifty dropped 38% from its peak in January to its low in March, reflecting a sharp equity decline. Meanwhile, gold prices surged 25% during from March lows, outperforming all other assets. Right, gold is where people said, "Oh, let me invest money in gold rather than." But it is also possible that at the same time, many people, if the COVID impact was longer, many people would have come and said, "Let me sell the gold because I don't want to sell equity and debt in this market when there is so much of uncertainty." That is also possible. The negative correlation between stocks and gold and bonds help portfolio with diversification, because your equity and debt may have suffered, but gold actually went up during that period. So Indian equities and debt, I think there is a low to moderate negative correlation. Bond rises when stock prices fall because people get risk averse. Indian equities and gold is, I don't see any great correlation. If anything, it could be very low. And during certain times when debt and equity are doing badly, gold could be doing well. Indian equities and real estate Many people, when they are selling their ESOP and they're booking a lot of profit, let's say you've sold your ESOP and you made 2.5-3 crores profit, it's a great time to be buying a house, is what people think. So you save tax. So what's so bad about it? So some people do that, or even when they're helping their children buy a house. So if if your children are buying a house, let's say your son and your daughter, or your son and your daughter-in-law are buying a house for about 4 crores, there is no problem in you selling off some of your shares worth 10 lakhs, which has now become 1 crore, and adding your name to the house, and then making a will and giving it to them, because that way you avoid all taxes, you avoid capital gains tax also. So some of that can happen. So therefore, when when equity is booming, some of that money can go and buy real estate. So is there a correlation? It's very difficult to find out. Sometimes it is there and sometimes it is not there. So what all can you do? One, diversification. By mixing asset classes with negative or low correlation, you put money in Indian equity, in foreign equity, maybe in Japan, in Europe, in US, right? So your equity itself is diversified. You again put some money in government bonds, maybe in mutual funds, right? So it's easier to invest in debt through mutual funds than through your than going directly buying and selling GSEC. You put some money in the Sensex, saying I'm not sure. It is ensuring against my stock picking skills. So I have stock picking skills, so I create a portfolio. I want some money to be lying with some couple of fund managers, right? They're good fund managers, and some money in an index fund, because end of 3-4 years I can see whether my own portfolio is beating the fund managers, or is it beating the index. If it is not beating the index, I might as well decide to put all the money in the index. So these are types of diversification within equity. Then there is international diversification within equity. Similarly, you can do with debt, right? So I have invested in a global REIT, I have invested in a global debt, and I have invested in global equity, which is aiming debt-like returns, in the sense it is aiming dividend yield kind of a thing. So I have invested in all this. Maybe these are small amounts, but this is a method of reducing the risk of investing in Indian equities. So gold bonds, SGBs were good, but now it is gone. Portfolio sizing decides how much of risk you want to take and how much you want to be defensive. So when you're younger, you put more money in equity. When you're older, you put less money in equity. You put more money in debt. You use gold more as an insurance. When these two are not doing well, gold will perhaps do well. In practice, I don't see too many people rebalancing very sensibly, but yes, once in a while people say, "Arey, equity has gone up too much, let me sell that and buy a house, or let me sell that and put some money in debt." It does happen, but I don't know whether it happens very scientifically. But you can also sit and do it very scientifically, or do it on maybe in a haphazard way, but you know what you're doing. Thank you.